talked to Erik and Lassila from Peakview Capital. And Erik, you guys have had a couple of funds so far and had some success. Hoping that you can give us some great insight into what you're doing, what you've done, and what the future looks like for you.
Great. Thanks, Marty. And good to see some familiar faces here. Thanks for having me on. And Marty, especially, thanks for still having me on after my Jeffrey Toobin moment this morning of asking my son about his hygiene when I didn't know it was unmuted. So let me just
we'll cut that part out of the video.
Okay. So, you know, let me just go back for a second. I'm Erik Lassila, so I've been a long-time venture capitalist. I founded Peakview Capital in 2015 after kind of designing what I think is the best strategy for getting high-risk adjusted returns in venture capital. My team put together quite a few slides, so I'm going to move through these quickly, and you know, feel free to jump in with questions. I love just sort of interactive. And so Marty asked me to start with my background. Been a venture capitalist since '96. Before that, I was in technology companies in operations and marketing. Went to Stanford and then started with Mayfield Fund in the mid to late '90s. Invested with several firms, with a few firms actually, with Charter Ventures and Clearso Venture Partners. Spent a little bit of time in China to invest in growth capital. And when I came back, that's when I kind of looked at how to design that the right kind of fund structure for the current environment of venture capital, which has changed a lot in the last 10 years or so. But during my time in venture, I co-invested with almost all of the top firms. Started with Mayfield at that time. Mayfield is really one of the premier groups, so we co-invested with just about every top name and spent years on boards of directors with people in these firms. And so my sort of class of venture capital grew up to be now what many of them are kind of managing partners or senior partners within the venture industry. I was the chairman of a group called the Young Venture Capitalists Association, which later merged with the NVCA. And my investment track record is there at the bottom. Let me just go to the next slide, has a little bit more data. So we invested, I guess, with my firms, I was responsible for 120 million of capital in 27 companies, fairly early stage. And in those days, 1 to 3 million was pretty typical, or 3, maybe 5 million was not atypical Series A. Many board seats and had some great wins with financial engines, led the Series A round there, went public, still public, now being acquired. Interwoven, which was led the Series A, software company that had a great IPO later. I was on the deal team for PayPal and the Series A, and of course got to know the PayPal mafia, which is now taking over the world in tech. And then some other companies that were acquired favorably. So my personal track record is strong. What we do now here at Peakview is sort of focused on fund of funds. It's primarily fund of funds. And the thinking behind this is that, over the last 10 years especially, the top sort of the well-known firms, not necessarily as well-known, but the top firms have even stronger deal control than in the past. And so the question is, how do you compete with firms that have a couple billion in dollar funds, and they have extraordinary reach. They see every deal. They have brand recognition that means entrepreneurs seek them out. And so we didn't want to compete directly with those firms, but we wanted to find a complementary strategy. So we because of the relationships, we're able to invest in really the sort of top tier groups, and then invest directly, selectively in their portfolio companies, not really as LP typical co-investment, but from a venture standpoint, and assisted by the relationships with the VCs that can help us get into those deals. Because as you know, the best companies are really tough to access. So we started Peakview in 2015. we've raised 4 vehicles, and now we're just starting. We just did our first closing on our 4th fund. So far, the results have gratified that they've been sort of borne out the strategy and fairly consistent performance by creating a small basket of large allocations in top tier VC firms. And those are some of the ones that we're involved in. So if you kind of think about our overall, the difference between, there are plenty of fund of funds out there. The challenge with the fund of funds is once they do well, they raise more and more capital. And in venture capital, a lot of capital doesn't work well because they need to start investing in, you only get small allocations in these small funds, in these really top tier funds, if you're lucky. So with a lot of capital, you end up investing in tier 2 funds or taking more risk with emerging managers or newer managers. Our focus is, our strategy is to be very focused on the top tier with large allocations. We come from the venture capital world, as opposed to sort of general asset managers. I think that gives us both access, but also insight into what are the right sort of successful strategies going forward. And then, let's see, I just want to make sure we've got, should I expand this? Is that better? And then we also, have this sort of model that we think optimizes the fund for high risk adjusted returns by just selectively investing in the top sort of fast growth companies. Quick overview, we have $300 million under management at this point, registered with the SEC. We have strong support. This model that we designed, we started by really talking to the VCs and sort of saying, what nowadays, does the world really need another new venture capital fund? Should I start one of those, or is there a way that we can really join forces and be complementary? And so we've had a lot of support from the VC industry, both here in Silicon Valley and around the country, in fact, in other geographies as well. So I'm going to sort of initially give a little bit of background on VC. I think you've heard a lot about it, but I'll talk a little bit about the trend line for the top tier VCs during COVID and what that means for investing. But I think we're all familiar that groups like Yale University and others recommend to have 20% of their entire endowment in venture capital. It is becoming more recognized as a preferred investment for family offices, and there's a long-term advantages. There's also tax advantages, and also for family offices that have expertise in certain industries, you can co-invest. And we also value our LPs who have the ability and interest in co-investing with us. So Yale University's recent endowment, of course, everybody knows that David Swenson's returns have been great, and they have 21% in venture capital. And as we know, the top quartile, in venture, you really want to be in the top quartile returns, or you're just, I tell people, just go with S&P, because the difference between the top performing funds and the lower is so vast. And interestingly, as we'll talk about, a lot of these top quartile funds are very consistently are in the top quartile from fund to fund. The macro trends are looking strong for venture. More and more new business formation, which adds to our sort of target list for investment. Although there's been a lot of capital raised in the last couple of years, overall, for how much value venture capital and technology in particular has created in the last 10 years, it's kind of amazing that the number of VC firms hasn't really grown. The amount of capital that they have raised certainly has grown, but also so the companies are staying private longer, so they need more capital. So there are good structural reasons for that would point towards good returns in venture right now.
Erik, is this data U.S. only?
So yes, that's correct. And our fund is U.S. only, with one exception, which we're in.
Can I ask a couple of questions about the fund before you go to the next page?
Yeah, you bet.
So do you guys do secondaries or co-investment?
We have done some secondaries. We're primarily focused on sort of juicing our returns through those direct investments. So we do primary. In the future, we may actually have a secondary focus fund. Right now there's so much capital in the secondaries markets that I think that great returns in the past, people kind of looking backward, and I'm not so sure that they're going to be replicated in the future, because secondary.
Yeah, obviously there's a lot of players in secondaries and venture capital, but secondary venture capital saved a lot of Silicon Valley investors in 2009, right? Buying other people's stakes. But you're right. I mean, where there was 3 players, now there's 20 in secondaries.
Yeah, and more coming, and much bigger funds. And also, families and institutions are doing more in secondaries as well. And so, nowadays when we look at a secondary opportunity, it's much more liquid market. 10 years ago, you might be one or two bidders, but nowadays, they have a lot of people smart people come in and sort of, there's more of a market price on those. So yeah, I mean, one of the things that's interesting too is that I think we've all heard this, right? That private markets are capturing more and more of the growth and the value as companies are staying public, or staying private longer, and so a large private market strategy in a portfolio makes increasing sense. Let me shift a little bit to COVID, and I want to make sure that I've got a long ways to go here, so we'll work through these quickly. COVID's been so interesting for venture and for technology in particular. This is a slide from a VC firm that names are changed to protect the innocent, but this is pretty typical. The portfolios, more companies have benefited from COVID and are growing fast in the tech world than have been negatively impacted. And plus, the growth rates have been superb for the portfolios. VCs are doing this kind of analysis for their new investments. They're sort of saying, okay, is the impact from COVID temporary or is it structural? And then, what are the positive impacts, or the companies that are positively impacted in COVID, and especially startups. Startups need certain certain market characteristics to be able to get going. And the early stage companies in COVID, they can be designed to the market that we're in today. And as we know, many of these e-commerce has exploded in many categories. Nearly all categories, ones that we're familiar with. Telemedicine. My wife is the chief medical officer for a dermatology product, telemedicine, and they have seen 10x growth, and that's not uncommon these days. We view that as very much a structural change, in that telemedicine is 10 times cheaper and 10 times more effective, more efficient. So that's going to be a change that'll stay, and in many cases, remote working, other areas. So we kind of divide the world primarily kind of in a macro.
Erik, I'm sorry, Erik, that's a great slide. That's a great slide. You're going to share this deck with us?
I will. Yeah, I'm happy to.
Yep.
So e-commerce, we've really seen an acceleration of e-commerce, which means, and this is in many dimensions, right? not just the volume of of transactions and the revenue, but also in the consumer adoption. Like more people are doing more with online and e-commerce than in the past, and so we've seen just a step function in growth and adoption. And what I'm even more excited about, what's happened in the enterprise. Enterprise technologies have have more quickly adopted areas like business process management and digitization of certain processes and documents. So that's a kind of a leapfrog forward where many more users are in the market and available for these startup companies to sell to. Okay, so now just talk a little bit about the VC market in general, and how our strategy folds into that. As we all know, the great top tier firms or the top performing funds have done very well. It's difficult to invest in them typically because they don't always accept new LPs. And the conundrum, right, is that you look at the top 20 funds for any given year, it's really 2% of the funds are generating 95% of the industry returns in venture. And it's not always the same funds, but it's surprisingly consistent. I mentioned David Swenson earlier from Yale. They did a study and basically came to the conclusion that venture capital is the only asset class where you have persistence of returns. One group's capital is more valuable than another. Whereas in buyout and hedge and public markets, you have no advantage. So pricing is the same, but venture capital is unique in that certain firms tend to have an advantage that's replicable from fund to fund. So there's a 67% chance if a VC fund has a top quartile return for one, then for that vintage, then there's a 67% chance that their next fund will also perform in the top quartile. So it's that sort of replicability. And why is that? It's these firms that are very well known, brand recognition is really valuable to entrepreneurs. It helps them. If you have Andreessen Horowitz or Sequoia Capital as your lead investor, it helps to strategic deals. It helps you to get additional funding later. All these things add to the value of the company. So the VC, they're willing to take a lower valuation from these top tier groups. They have such reach that they see every deal, and then through the expansion of the teams, they get very specialized. Groups like Andreessen Horowitz is really interesting. They have 185 employees, each of which, all the way from the partners down to the staff level, are very deeply specialized and experts in certain types of industries and certain types of functional support for companies. And that's tough to compete with for smaller firms. And then I like to talk about, I grew up in a blue blood firm, and I really saw that there is institutional learning that comes from seeing thousands and thousands of companies over a decade or two or three, and getting the pattern recognition of the characteristics of entrepreneurs that can make the company work, and the types of business models that tend to be successful, where the landmines are for different types of businesses, and that institutional learning gets passed on through the generations as they bring up new GPs. Then there's other things too. Geography is less of an issue now, but in some industries like financial services, you really have to be local. In other words, different countries have different regulatory and structural and consumer behavior for financial services. So, as just how we have interesting companies like Chime and all the other companies that are reforming banking and other areas of financial services, those are being replicated in places like Brazil. So South America is interesting. Europe is interesting, but has other challenges. And the larger firms have more reach and resources to address those.
Hey, Eric, quick question. So you're talking about 20 VCs return 95% of the return in the space. What about these VC networks that have come about? You have like I'll give University Ventures or Venture University. Like University Ventures is a series of venture capital funds that are distributed among top like 50 universities. Number one. Second, Venture University is an educational venture capital sort of venture fund where they have. I mean, what I'm seeing is like this explosion in what they call partners per se, but they're actually not partners. They're not general partners. They're not limited partners. They're just finders, right? Like, business partners, so to speak. So do those guys move the needle at all? These aggregations of like distributed. I mean, maybe Draper is the only one that's really distributed in different cities that has had success. Are any of the other ones moving the needle, or?
So yeah, it's a great question. And we look at a VC firm, and we look at hundreds of them, and we keep in touch with hundreds of them. So we don't want to miss the next great fund. But we wouldn't look at them. We look at that sort of aspect of proprietary deal flow. That's the key, And programs like that can do a lot for newer firms. Nowadays, I was going to say, like all of the top tier groups have these kind of scout programs where they'll have 50 or 100 people that are tied to the firm. If they bring a deal, they introduce a deal, then they get to invest, and they could actually get part of the carried interest on the deal. So it's not a new concept. I mean, most of those top 20 will have programs like that.
Gotcha.
So our strategy, again, I think I already covered this pretty well. Our Fund 4 is going to look like this. We just did a first closing, and we've made a couple of allocations, a couple of commitments. $200 million fund, roughly 20% of the fund will be direct in what we call inflection stage companies. We want to get sort of $3 to $5 million to work in a company that hasn't been recognized yet by the typical growth capital world, but the early investors have already seen that there's something really special going on. Those deals are really competitive, but through relationships and also through doing our own homework, we're able to access them. We're keeping the bar very high on those direct deals, and if we don't have what we think is world game-changing kind of companies, we're happy to keep with more most of the fund being, or nearly all of the fund being funded.
Let me jump in again, Eric. So on these direct investments, you're not the lead investor; you're a co-investor typically, right?
We are, yeah. There's a couple of different ways we can do that. We can invest. I have a slide coming up here. Let me come to that in just a little bit.
Okay.
We have a great team, and people who are specialized. Our CFO was the CFO of Meritech Capital, which is we believe one of the top, maybe the top growth capital fund, and August Capital. And as I mentioned, these are folks here who are at top firms. Samir Gandhi and Ravi Matre are the managing partners, lead partners for Accel and Lightspeed. Matt Murphy at Menlo Ventures, Steve Jervitz. All of these folks were involved in in creating that Peakview model, and they're happy to take reference calls for us. And also, they'll tell you that when we have co-investment opportunities, Peakview's approach is really helpful for them, because they know that we come from a VC background. We can move quickly, make a quick decision and also bring some value to the table, because we come from that VC side. And there are quite a few others that are involved. With fund of funds, of course, it's not about having 6 or 10 relationships. It's really knowing someone very well who's a partner in every fund, every firm, and we cultivate those relationships. For me, most of these are my relationships going back to Stanford, which is kind of a breeding ground for venture capital. People that I knew from funds that I've been with, people I've been on boards with, previous investments. Frank Wong, my partner, has a very similar set of network that brings to the table. And we're at that sort of stage in our career where people that we grew up with in the industry are now senior at a lot of these firms. The quick, I guess, quick description of, we select funds by doing all the homework on the quantitative side, but really drilling into the portfolios, really understanding the insight or the strategy behind the investments, and then going to the next level, which is, in my view, the most important level. It's how does a partnership make the best investment decisions? I've been in partnerships, and it's what works the best is when you have a meritocracy of ideas and people can share their views, and hopefully the team, when they work together well, can come up with a better decision than any individual. But the dynamics change as some partners, get a little older, maybe have made a lot of money and less motivated. Are the firms incentivizing the younger partners well? And what are the VCs like to be on their boards? They really help the companies. And it's that kind of insight that comes from personal relationships that helps inform our investment decisions.
Erik, most of the firms that you're investing in are pretty large, but I think you're just answering my question, which is, are you investing in seed and early stage? Got it. Go.
We do, yeah. I mean, we have a few groups that are. We think it's important to have a balance, really, of seed and early, and also some growth. That gives you some diversification across time frame. It's just companies, growth companies might have been in existence 3 or 4 years ago. So, sort of diversification across time and valuation and sector. And then our core is really around early stage. The sort of Series A oriented groups have a lot of investment in seed funds as well, in their seed programs. That's how we try to balance it. These firms, if you kind of take any major name tech company in recent years that's been formed, they're typically venture backed, and they're typically backed by firms that we closely work with, Andreessen Horowitz, Excel, and others. And their portfolios, it's fantastic as an LP. You get good data on the portfolio companies, but also the relationships enable you to say, we go on ski trips. We went to Switzerland right before COVID hit, and you go on a ski trip with people. They'll say, like, yeah, I'm amazed at how this company's growing. Like, you've got to find a way to get some capital into the Series B in this deal, and that kind of information, it helps us send us in the right direction for our own due diligence, for our own research, and then helps us to access those deals. And I mentioned this, it's really, we want to invest right soon after, probably the Series B or C, after there's an early stage, very strong sponsorship from a great fund, but before the growth capital groups really get involved. And we're making small investments in these companies to make sure that there's good diversification within that direct bucket. Characteristics for our companies. And Marty, how much time do I have? I want to check in.
About 5 more minutes, Eric.
All right. So we want to have the emerging portfolio winners, the companies that are really going to move the needle. We've had companies like Chime, Carta, App Dynamics, even Uber, and several others were introduced to us as early investment opportunities. We didn't have a direct fund at that time, but we do have access to those kind of companies. We look for top, A+ management teams. There's no compromise for that. It's the most important ingredient in startup success. But we try to invest. We hope to invest after most of the main risks are addressed. We don't want to take product market fit risk or business model risk, or typically management team risk. And of course, companies that are in industries that could be 5 billion plus within 5 years. This is the co-investment slide that I mentioned earlier. So we don't wait around for the phone call from a VC that says, yeah, our company's raising a Series D. There's some space in the round. Do you want to take a look? That's usually the call that you don't want to get, because it means the company doesn't have 10 term sheets from other from institutional investors. So we look for areas where we can sort of squeeze in 3 or 5 million, or if we have really informed insight about a company, we will buy from a secondary source, buy off the cap table. And another strategy that I think one of my favorites is to lead around for a VC. We're looking at a company right now where the Series A investor wants to get more ownership. The company's doing so well. They want to get more ownership in the Series B, but they need an outside lead to come in and price the deal. Entrepreneurs usually want that. So they can bring a friendly group like us in that doesn't have a need for 15 or 20% ownership ourselves, and we can lead the deal with a small amount of capital, and they can put in as much as they want behind us, and then so it's a strategy that helps the VC to get done what they need to. We also expect quite a few co-investment opportunities for our direct. Not all of them. I mean, usually these are highly competitive, but we will have co-investment opportunities for our LPs that are interested. We have brought opportunities to them and plan to do more of that. Okay.
That was actually my question, Eric, was about how on your direct investments, if you're co-investing, can you daisy chain your LPs into that co-investment as well? And you just answered it. So.
Yeah, and I love it when like families in particular, if families tend to have within their groups, really deep domain expertise in the area that they kind of made their fortune in. So it's a great opportunity to bring somebody in, and that comes with due diligence. And we love especially families because they tend to move quickly, and the best deals move quickly as well. So that's really I think it covered most of the main points here, and I want to leave a little bit of time for questions, but we had a few along the way. Feel free to send me an email anytime, Erik@peakview.capital. If you have other questions now, or you want to follow up, I'd be delighted to chat.
Erik, I just have like 1 or 2 quick questions, and then we have to break because I got to catch a plane and we have to go and have a drink first. So just real quick, general thoughts about the marketplace. What do you see as hot areas to be? I mean, are you thematic in the way you invest? Do you say, I think this is going to be a hot area to invest, so I'm going to make sure that I'm in this part of Andreas and Horson's fund? Or do you say, Andreessen Horton is a great manager. They perform. I'm in. Or is it a combination of both?
Oh yeah, well, so we definitely don't take a VC's word for it. I mean, no matter how good your relationship is with a VC, people fall in love with their own deals, and so they're gonna tell you great things about the company. So we do our own work. But so after being in this industry for 20 or so years, I only invest. We invest in areas that we know well. And if you've been investing for 20 years, then you've seen a lot of areas of consumer technology and enterprise technologies, hardware, semiconductors, and others. But we won't invest in healthcare. We just don't understand it well enough. We won't invest in most other sort of foreign markets. And we do have certain areas that we track closely. I mean, I think fintech is just, we're at the tip of the iceberg right now. Things that companies like Time are just going to change the way the industry is structured. Business automation, vertical SaaS companies, have a long way to go in automated business processes for companies. The cloud has already happened, and that leads to a lot of new opportunities. We're also excited about certain areas of consumer where there are strong network effects, where you have low cost of sales because the customer adoption happens by itself. But I'd say in general, we're pretty open to most areas of tech. And of course, we have people we'll bring in as experts to help inform certain decisions if it's an area that we don't have a lot of experience in.
Great. Any other comments? Any closing thoughts, Erik?
I think I will just say overall, venture. You got to think about what's happened to the economy. Technology is kind of leaped forward, and innovation. What I've seen for the last 6 months, more companies are being started since COVID than I've ever seen before. So it's going to be a great time to invest. We're very optimistic for the 2020 and the 21 vintages.
Fantastic. Well, listen, Erik, thank you so much. We're going to be in Miami on December 9th. We're going to be in San Francisco January 12th and 13th. Thank you, Nelson Mullins, for hosting us. Your contact at Nelson Mullins is Michael Hollingsworth, and feel free to reach out to him. I will be sending you his contact information and everybody else's contact information as well. Feel free to reach out to me if you have anything interesting going on. If you want to suggest a book to read, etc. But again, thanks so much, and we'll be seeing you in the next one.